Welcome back. The market's color is very definitively red today. The bank nifty continues to struggle, 0.8% lower. The mid-cap index is down 0.5%. The breadth is even Steven, but more favoring the declines than the advances. So it is a very feeble and fickle kind of a day from the bulls' perspective. Let's take this to a more medium to long-term conversation. Jigar Mistry, co-founder at Buoyant Capital, is joining in. Jigar, always a pleasure having you on the show. Thanks for taking out the time this Friday. So you tell us, this market has been a little perplexing. We all understand that we were underperforming because we were the outperformers of 2022, but all the events have happened, credit policy, budget, etc. And it seemed like, just the last 2 days we were getting into some sort of a breakout, and then we're back to the slump again. Is this how you expect the rest of the year, or maybe at least the first half of the year, to shape up?
Hi, Surbhi. Good morning. Thank you for inviting me to your show again. Right. So, if you take a step back and look at what was really transpiring, like last 4, 5 months, I think the market took the cue that apparently, while we were discussing between, say, a hard landing or a soft landing in the US, they said, okay, why not a no landing at all, implying that growth could continue and Fed could actually keep hiking and both those situations could coexist. Now, frankly, that does not really happen. And if you sort of look at why the market was thinking that, you look, say, CY22, in the first quarter, Fed withdrew something like $250 billion in liquidity in the first quarter, 700 billion in the second quarter, 150 in the third. And suddenly in the fourth quarter, that reversed, right, dramatically. So I think they ended up pumping in another $200 billion. And the market thought, look, the rates are done, hikes would happen, and then, we are back to business again. What they did not really read through was that it was not really the Fed pumping in the liquidity, but there's a technicality called the TGA and RR, the Treasury General Account and the reverse repo business, which actually pumped in the liquidity. So Fed kept saying something while the implication of that was totally reversed. And if you look at the stocks that have gone up since October, they are exactly a mirror image of the stocks that went down in the previous 8 or 9 months. Now, the thing is that, such a strong economy, the data numbers that you are looking through in the US, it's unlikely that the Fed would pause anytime soon, which means you're now talking of five quarter range of the Fed fund target rate. And then you sort of keep adding it back, right? India is at least 200 basis point now, used to be almost 800 basis point differential in 2013. And that does not really leave a lot of scope for the markets to rejoice on a continuing basis. Eventually, the TGA and RR will have to subside. Fed will continue reducing the size of balance sheet, and then pain, will start reappearing. So my sense is that, and one last point I'll add here, you look at 2005, the Fed fund peaked at 5%. The S&P rallied 20%, and the house prices kept falling. And then you had 2008. Now, if you look at the data since October, the house prices, or not really house prices, but the new housing sales are actually falling at a faster trajectory than the global financial crisis. So my sense is that, we need to sort of take things into perspective. The brace for impact sort of portfolio stand should continue. And, businesses appear very, very cheap. Then one should sort of look at getting them rather than actively looking for multi-baggers.
At what point would you draw the alarm on this US housing data? The new home sales are falling faster than what we had seen in the global financial crisis, because you did compare what is happening currently with 2008 and the run up to 2008. At what point should we be alarmed?
Hi, Rima. So yes, look, the banks arguably are not as leveraged to subprime as they were in 2007-8. And that was arguably the first time all of us learned what QE, QT really meant. And therefore, the impact may not be that large because, you don't really have this situation of a very large theater and a very small exit gate. And therefore, that leading stampede effect that you otherwise see. But housing and real estate still form a very large part of incomes, or rather the wealth of a lot of US citizens. And, house prices falling, home sales not happening is definitely going to bring some sort of a wealth impact that will be meaningful. So my sense is that although it may not be as dramatic as it was back in 2008, because you had the banks leverage 30 to 1, 20 to 1 on the base of a deposit. That's no longer, or hopefully that's no longer the case. And therefore, it might not be as dramatic, but no reason to rejoice in a big way either.
All right, got that. Thanks a lot for joining us, Jigar. I'm going to ask you about some specific stocks which have been in focus. Let's start with Divi's. I mean, of course, in the past couple of days, ever since its results, it's down around 15-16%. But can you tell us what you think of this? There was a sharp contraction in margins, which has, of course, really weighed on the performance. But your thoughts on this one?
Hi, Pavitra. Yes, so okay, you look at this from, say, pre-2020 levels. Pre-2020, this company used to do a revenue of, say, 1,400 crores and EBITDA of around 300 or 400 odd crores. So there was a mid 30%, 34, 35% margin. And it was already big in 2 or 3 molecules, right? The pain management, gabapentin, etc. And globally, it used to command almost 50-60%. Then suddenly COVID struck, and molnupiravir basically then picked up. And therefore, that 1,400 crores revenue, fast forward 2 years, that went up to almost 2,500 crores. Margins expanded to 40-45%. EBITDA went to 1,100 crores, if I'm not mistaken. And people were very happy that, this could arguably continue. One school of thought clearly was that you'll see this turn around eventually, but people thought that there are three or four other sort of molecules where it is currently at 10-20%, and then that could pick up by the time the impact of molnupiravir reverses. That sadly hasn't happened over the past 2 or 3 quarters. So stock, which was trading at, say, 1,400 rupees per share, went up to something like 5,400 was its peak or something. And then, as the earnings have corrected, it's come back to something like 2,700 rupees or thereabouts. Now, if you look at the latest quarter, and all the past 3 quarters, the street was surprised, how difficult it is. And then stock falls each day on the result date. And then, the margins actually contracted to under 30%, I think, since quite a while now. That we have seen such a number. Revenue still went up to 1,700 crores, but EBITDA, I think, came in around 400 crores. So whereas the molnupiravir impact faded away, the cost created to service that clearly have not. And therefore, I think the surprise on the margins. If I look at the stock from here, my sense is that you would see the management was on the call saying that molnu impact is almost zero. Now there is no inventory. Secondly, the 3 or 4 other APIs that they're working on, that will clearly drive growth. Margins could normalize. And, if you look at the reverse DCF on this, you are sort of building in a 17-18% free cash flow growth, which I think if you look at the last decade, it's a pretty similar number.
Yeah.
So I think over the next 2 quarters, things might sort of dial down and stock could do well from here on.
All right, stock is likely to do well. That is the view from Jigar Mistry on Divi's Lab. Jigar, we'll leave it at that. We would have loved to chat some more, but we're completely out of time. So look forward to having you on the show again. For now, we do have to get into a short break now, but there's lots more market action coming up for you in just a bit.